We've really gone through everything. We looked at the CEO, we like it, YouTube videos, we looked at the financials, we listened to the earnings calls, we like the company. Now we're going to value the company. All right. So there is a 3-question filter. This is going to remove 95% of stocks. Here's the 3 questions. Will the company grow over the next 5 years? You got to look at revenue, earnings, and macro trends. If there's no growth, if there's no growth coming, it's probably a value trap. And we've seen this, for example, with certain stocks during the pandemic. There was some stocks that thrived a lot because of the pandemic, but we knew they weren't going to be able to keep that trajectory. And a lot of people were buying those stocks with that being priced in already, without that being priced in. And then once it was priced in, huge decline, but you bought it at the peak. Okay. So you got to be careful with value traps. So you have to feel like the growth is going to continue for the next 5 years. If not, it's a value trap. Will the company have a PE under 15 based on next year's earnings? Helps avoid overpaying for average companies, number one. Number two, for tech stocks, you don't use PE. You want to use PEG ratio instead. Okay? Very important. Because if you use PE for a tech stock, you're not going to buy any tech stocks. None of them. Because none of them are trading at 15. I mean, there are some, but those aren't the ones that are growing. All right? PEG focuses on growth. Do you trust the CEO? And honestly, the CEO doesn't have to be the next freaking Elon Musk. I mean, some people wouldn't even use Elon Musk. Jeff Bezos, the next, Apple CEO, Tim Cook. They don't need to be that. They just need to not be the CEO of Nikola, where they're going to literally destroy your company by themselves. You don't want an ex-con man who has a rap sheet of fraud running your company. All right. This simple filter eliminates 95% of companies, guys. All right. And one of the ways you can do this is by using what do they call these? I'll tell you right now. Oh, a screener. I'm sorry. So this is FinViz, and they have a free stock screener. But usually when they're free, they have they're not as robust as far as features are concerned. So I will use, and whoever your brokerage account typically will have a screener as well. So if you look at my screen, you can see their stocks right here. If you go to news and research, okay, and then you go to stocks, you're going to go to this screen. Here's the screener tools. So start a stock screen. And there's going to be more options, probably more options here because Fidelity makes money off of you. Unless you're paying for FinViz, you're going to have a limited, see how even this trades is elite only. Okay. If you're looking at my screen, you can see like it's only one feature that I believe. No, they have fundamentals here. There's actually a lot to choose from here, actually. But like ETF is super limited. Yeah, there's actually a lot here. Not as much as with your brokerage, probably with Fidelity, but there's a lot there. So if we look at, what we're screening for, again, we want something that's going to grow over the next 5 years. So let me see if I can do this with the free one with FinViz. I'm going to zoom in. Whoops. There you go. All right. So if you want something that's going to grow, like you want a stock that's going to grow, like you're a value investor, you want to do mid and small caps, maybe large caps, okay? Because the probability that Amazon doubles next year is like, it would have to be insane, because it's already a $1 trillion company, right? Now, a company that's worth $10 billion has the opportunity, it has more likelihood, depending if it's a good company or not, of doubling in the next couple of years from 10 billion to 20 billion, or from 200 billion. We saw Nvidia 5x in a year from 200 billion to trillions, right? So if you're looking for something like that, you probably want to look at mid caps, large caps, small caps, okay? If you're looking for something like I am, which has volume, has potential to grow, I like to look at large and mega caps, all right? So we'll do large. EPS growth the past 5 years. We want something that we know has grown. And so you can put over 15% or over 10%, but I really want future growth. And I doubt they're going to have that here. Let's see. Oh, growth next 5 years. Okay, so this is the number that we want, and we want this to be over 15%. All right. Remember, they wanted it to be a PE ratio of under 15. Okay. We can do that, but if we do that, that's going to eliminate a lot of our tech. And so I'm not going to do that. I'm going to go to PEG ratio, and I'm going to go under 1. Remember, it says it here. It says it in module 1. Under 1 is what's best. So let me just make sure that I put here, even though it's in the first lesson or in the previous module, we'll put it here as a reminder, make it more convenient for you guys. Perfect. So under 1, and then my next screener is, do I like the CEO? But that's okay. We're going to go ahead and start this. And you guys can see there's only 8 companies left. All right. There's only 8 companies left. So I'm going to put any on this one and see what pops up. All right. Now we have more of a list to look at. So we can look like at Ally Financial. What I like to do is go look to see if there's any brands that are familiar to me. Look, you have Carnival Corp, Coterra, DaVita, Citizens Financial. I don't like banks. You have, Fidelity, First Solar. If there's any companies that you like, that you use, Micron's probably a good one. I like Micron. Let's look at Micron. It's starting to grow. Now, it's MU, the stock ticker. So I'll go back to Qualtrim, and we'll take a look at this company. And so we can see it grows. It's a little bit all over the place, but it is growing. If you know about Micron, you know it's an important part of, and it has a lot of partnerships with semiconductor companies. I don't love the financials right now. The free cash flow, the EBITDA. This doesn't look beautiful, right? We're looking at the debt. So I'm not saying it's not a good company. It's probably a good company, and we can write it down, but I definitely, just looking at this, I need to do some due diligence. Not saying it's not a bad company, okay? But that's the gist of it. And so you need to look at as many brands as possible now, and that's how you're going to start creating your watch list. I like to do a combination of this, watching other YouTubers that I trust that have already done their research, like Joseph Carlson, and then I'll go do my own due diligence on those stocks. And FinViz is free, but you can also use Fidelity. FinViz was very easy. I like it. Now, once we've done that, we have to see if we trust the CEO, which you can look up the CEO, Google him, ChatGPT him, YouTube him, all that good stuff. And let's just say we ended up keeping MU. All right, MU is going to be the one that we stick with. All right, so next, we're going to use our valuation formula. And I'm going to show you guys the easiest way to do this. So how you evaluate a company is expected return, okay, is earnings yield plus growth rate equals expected return. You want to go with the highest number. So if you go through 5 companies and you use this formulation, the company with the highest number is probably your best bet. All right. So we're going to use this formula. To evaluate MU. And all I'm going to do is I'm going to use ChatGPT. I know it's so difficult. All right. So this is what I wrote into ChatGPT. You guys can see. Okay. I literally just copy and pasted. I said, can you use this formula to evaluate Micron? Okay. And there's the formula. And let's see if it spits it out for me. And we can check the sources to make sure that the numbers look accurate. And here we go. And we can fact check this as well. What the forward EPS is, the current share price. Let's see if the current share price is right. 95.85. Let's go back. They got it at 96. So that's close enough. You guys can see the number they got was 4.36%. So we're going to write that down. And we're just going to do the same thing with every stock that we find. And the one with the highest number is the one we're going to go with. I'm sorry, 77.97 is the number. Okay. That's the number that we're going to go with. All right. And so if we look at 5 companies and 77.97 is the best number, well, that's probably our best option after We've looked at everything. But if they're all high, just put them all on your watch list because it doesn't need to be perfect. That's the beauty of this system. Remember, we're just collecting premiums on them. So if you're doing 5 different companies and 4 out of 5 do not assign the shares to you, that means you just collected premium of 4 out of 5, and you only have to worry about continuing the wheel with the one put that assigned the shares to you. All right. I'm hoping I didn't confuse you guys. Now, this is just a quick chart to show you guys PEG ratings. Remember, we're okay with fair value when we're selling puts. We're okay with it. So anything actually, I was showing you guys great companies under a 1 PEG ratio. But if it's 1.5 or 2, if it's fair, shit, we'll probably do those too if we have conviction in that company and we're okay with holding that company long term. Sometimes there's going to be markets where you're not going to find excellent or good value. You might just see fair. And so you just have to make sure that your risk management, let's say, you're using a 0.2 delta, 0.3 delta, use a 0.2 delta on something that's fair value. If it's an excellent deal, use a 0.3 delta, collect more premium on this. You have to use your own due diligence to decide what the best choice is for investing. So here's an example screener where you guys can see the PE ratio of Apple is 25. That's great for a tech company. The PEG ratio is 2.5, so it's overvalued. Even though the PE ratio is super low, guys, look at NVIDIA compared to Apple. Way higher PE ratio, which means if you were only looking at PE ratio, this would be way more overvalued. But if you look at the growth rate, expected growth rate, and you look at the PEG ratio, it's actually a good value. So we should be selling puts on NVIDIA right now, which I'm going to do right now. Shout out to this, right? Microsoft is showing overvalued. Palantir is fair. Amazon is fair. Let me go sell some puts on NVIDIA while we're here. Okay, and so here's the takeaways before we do that. All right. You always start with the 3-question filter. You use the PEG for tech, and you use PE and earnings yield for other sectors. You calculate your expected return before investing. You can use Qualtrim or any other. There's free sources too if you want to, or you can use Fidelity to look at all the financials and all of the stuff that the data that you want, the metrics that you want to look at. Only sell puts on companies you'd be happy to own long term, and sell covered calls if you get assigned, or continue compounding into your base, or just hold the stock, right? So here's the valuation checklist. 1, apply the 3-question filter. 2, calculate earnings yield and growth rate. 3, use PEG for tech stocks. Check valuation tools on Qualtrim. Decide, are you going to own, sell puts, or are you going to move on? That's simple, guys. That's simple. And so with that being said, guys, there's 2 bonus lessons here. We've already kind of gone through how to read financial statements. This goes deeper into it and gives you examples. You're more than welcome to go check that out on your own. And then Tax Strategy 101, same thing. You can look at this on your own. But I highly recommend checking out, talking to an accountant or CPA to help you with this stuff if you're going to take this serious. Okay. So that's it for the stock investing course. While we're here, let me go ahead and see if NVIDIA is still a good buy right now. So we're going to go to Fidelity. I need to go to my watch list, go to invest, watch list, and let's check out NVIDIA. Sheesh, it's up 3.64%. I don't like that, but I think it's gonna get to all-time highs again. So freak it. Let's see what happens. All right, so it's at 134 right now. Let's look at the delta, 120. Okay, that's not bad. 120 strike, and the stock is at 134.63. And the premium for that 0.2 delta at 120 is $2.50, and that's at a 0.2 delta. Okay, so here's my screen of everything that I wrote down. Let's do the math on this. 100 divided by 120 times 2.5. Yeah, it's a 2% return. Let's do it. Let's do it. Let me see if I can do 3 contracts. All right, guys. So we got 3 contracts. Let's place the order, and we're in there. So I have a whole bunch of stuff that's expiring June 13th. Let me just make sure that is June 13th. Yeah. So I have 1, 2, 3, 4, 5, 6 puts that expire in 30 days. So now I'm just chilling. I'm literally just chilling while my machine is dollar cost averaging into QQQ and into VOO, and I'm putting 1,000 a week into the brokerage, and out of that 1,400 is going into my base. So now I'm just chilling, seeing if the premium, if I get realized gains, if I can collect those premiums and they're realized and I can close those puts, then I'll go ahead and continue building my portfolio from there. But I'm happy with the positions that I'm in right now. The market looks bullish, and yeah, that's the stock investing course. Some of this stuff might have went over your head. What I highly recommend is watching it again. And any questions you have, man, Google it. Comment below the questions. Chat GPT. Go actually press buttons and experience this stuff. And if you want more, okay, you can. I just started this, and it's only going to be $15 a month. It's not going to be a stock invest. Everything that I'm going to put out, I'm going to put it out for free on my live streaming channel, and then we're going to clip it on my main channel. But what I think I'm going to do is I'm going to teach you guys how to at least create your first foundation, which is building businesses. Building businesses. So if you need help with building businesses, take a look at this school right here. It's only going to be $15 a month. Right now, there's a 7-day free trial. There's nothing in it yet, but we're building we're going to build the curriculum, and then we're going to build the community. And I'm going to teach you guys a whole bunch of stuff, but I'm also going to give you a free CRM so that you can control the marketing of your business. I'm going to teach you how to run ads, paid ads. I'm going to teach you how to scale your business, how to run an FBA store, a Shopify store, how to build a brand. All that good stuff is going to be in here. So if that's something you're interested in, you're going to get software, and you're going to get courses and a community for $15 a month. If you got any value from the stock investing course, then you'll get a lot of value from the snowball. And again, like I said, there's going to be this is great for people who need to build their base. I couldn't stress it enough in the beginning of this course how important it is to have a strong foundation. The main thing needs to be the main thing. And so the snowball is going to help you build the main thing so that you're making so much income you could really take advantage of building wealth using these stock investing strategies. And I'm even going to like the real estate stuff, I'm going to do for free on my channel as well. But for the foundation, if you want to build a business that's going to unlock the opportunities to do the real estate, to do the investing in stocks, to scale your businesses even more. And you're going to see that for free on my channels. But if you need help getting to the next level with your foundation, the snowball's for you. Good luck, guys.